Buying a home comes with a few decisions that quietly cost buyers thousands of dollars, and most of them never get explained until it's almost too late. I get the same handful of questions over and over, whether I'm walking a buyer through a house on the water, negotiating a rate buy down, helping someone accept a gift from a family member as part of their down payment, or explaining why a detached home is suddenly being treated like a condo. These aren't rare situations. They come up constantly, and almost nobody explains them clearly before a buyer is already under contract. So today, I've got Vincent Newsome from National Mortgage Funding back with me, and we're covering four things buyers ask about most: financing a home on the water, rate buydowns versus ARMs, using gift funds towards a down payment, and financing quirks that comes with condos and detached condos. So let's get into it. Vincent, thanks for being here.
Thanks for having me.
Great. So let's start with something specific to my market. Does financing a home on or near the water actually work differently than financing a regular home?
So it's a great question. Flood zones, they are a little specific depending on the property. So not a ton of changes when it comes to being in a flood zone other than the insurance portion. So if your home is free and clear, such as you having a cash buyer, they are not required to get flood insurance. That is going to be completely up to the client themselves. If you do get a mortgage on it, that's a different story. There are some things that the mortgage lender is going to look for, specifically a FEMA zone. When we do a mortgage, we do something called a flood certification. What a flood certification is, the lender checking to see if you're in a flood zone, and they will continue to check for the life of your loan. If you are in a flood zone at the start, you will have to get flood insurance. An easy way to check if a home is in a flood zone is actually going to FEMA and pulling up their flood maps. That specifically will show the home that you're looking at in the area to see if you're in a flood zone or not. Now, with that being said, if the mortgage lender does say you are in a flood zone and you go and verify that you are in one, you will have to have a separate flood insurance policy. Now, that will come in with a monthly payment, so that'll be part of your escrow. So if you say, well, Vince, I'm not going to escrow, that's okay. You don't have to escrow your property tax and your homeowner's insurance, but the lender will require you to escrow your flood insurance to make sure that it is being paid.
That's exactly why I loop you in even before we write an offer on anything waterfront. So let's switch gears. Rate buydowns and ARMs both get a lot of confident, contradictory advice online right now. Can you break down what each one actually is?
Rate buydowns and ARMs, we have a lot of clients taking advantage of those currently, especially in this rate market. So with rate buydowns, what that is there's a chunk of money that's set aside, and every month the difference of your rate, so if you do a 1.0 buydown, you're 1% lower than what your start rate is. That chunk of money, though, is paying that difference of the 1%. So that will last for that full 12 months, and then your rate will go back to where it is. So lenders right now are offering promotions where they are actually covering that chunk of money for a 1.0 buy down for clients. And they're doing that because they're hoping that rates will start to come down, and that eventually we'll be able to refinance and maybe get you the promotional rate, or maybe even lower, depending on where the market goes. ARMs are a little bit different. Those are locked in for a longer period of time. So there's a 7-year ARM or a 5-year ARM. A 7-year ARM option, you're locked in for 7 years. 5-year ARM, you're locked in for 5 years. Those are both on 30-year amortizations. So with that being said, your rate is lower for the first 7 years, and after 7 years, then you will adjust once a year. There are different caps. You can adjust 2% at a time every year after the 7-year period. And the lifetime, most of them are 5% overall. Again, those will vary depending on the lender that you're choosing and the product that they're using. Those 7-year ARM rates and 5-year ARM rates are advantageous right now, especially with the market being a little bit higher, where you're gaining that confidence of a lower interest rate for the first 7 years, and then hopefully you can refinance within that 7-year period if rates do come down, but you weren't paying the higher interest rate that's being offered today. Both great options, especially in a volatile rate market that we're in today.
I love comparing the real numbers instead of going off what sounds good online. So, next question, gift funds. A lot of buyers get help from family, but I know there's a right way and a wrong way to do it. Can you walk us through it?
Gift funds are on a lot of files. We see that often. What gift funds are is a family member or a friend, depending on the product, are gifting money to our client in order to pay for down payment or closing costs. So there is a right way and there is a wrong way of doing it. We don't like to see Venmo transactions, right? We want to see a wire transfer directly from the gifter to the giftee, directly to the title company, and the title company will hold those funds and then credit it towards the client at closing. Now, often we also see clients say, the gifter is not comfortable right doing a wire. We understand. You can do a check as well. What we usually do, though, is we want to see a copy of that check and then the exact amount being deposited into the client's account to make sure those match, because our job is to connect the dots. With that being said, we will always walk you through the correct way. I always will tell clients, even if you're not working with us, with whoever lender you're working with, you need to consult with them before doing anything, especially when you're moving money, to make sure you're doing it the proper way to make your life easier throughout the transaction.
So that one habit, looping me in before the money moves, prevents almost every issue I see. So last question, and this one trips up people constantly. What changes when a home is condo platted, even a detached one that looks just like a regular house?
Detached condos or site condos and attached condos, they are two definitely different properties. With a site condo, which is common really in Michigan, those are almost like a planned urban development. So they're homes, they look very similar in style, and they are detached, often with an HOA. With an attached condo, those are a little bit more involved on the HOA. So there's a budget, there's a board, there's things of that nature that the lender has to provide, or will look into, I should say, to make sure that there is no issues with the HOA to protect not only them, but also the client themselves. So with a site condo, we treat those really like a single family residence. We do have to verify HOA do so. That is a common difference with that. So if, let's say, you're getting a mortgage on a site condo and you do not have to get it appraised, which sometimes happens, and the appraisal is waived, the HOA will still need to be verified by the lender. So we will have to get HOA statements or something of that nature. On a attached condominium, those we do have to get something called a condo questionnaire. What that is we have to make sure that, let's say, the condo is not planning on building more homes, or there's not an insurance claim out on the building. There's no delinquencies with HOA dues with most of the tenants, those types of things. So there are different situations that we have to look at. Definitely a site condo, not that stressful. An attached condo, also not that stressful, but more documentation involved that we had to look into, which sometimes does delay the process a little bit more.
That's exactly why I flag it on the listing side too, so nobody gets caught off guard mid-transaction. So Vincent, if people want to reach out to you about any of this, where can they find you?
I can be reached by email, Vincent Newsome at nhemfunding.com, or directly at 248-388-5528, or on Facebook or Instagram.
Perfect. So if you're buying in Metro Detroit, whether it's a home on water, a condo platted property, or anywhere in between, download my home buyer's guide linked below. And let's get you the real numbers before you fall in love with anything. I'm Leslie Martin. I look forward to helping you make your next move.